Have you ever dreamt of retiring early, lounging on a beach while your money works for you? Many people think real estate is the golden ticket to that dream. But here's the shocking truth: 70% of real estate investors never make it to financial independence. That's right, most people who jump into real estate don't achieve the freedom they hope for. In fact, a study by the National Association of Realtors found that nearly 30% of rental properties don't even break even after expenses. This can lead to financial stress instead of the dream lifestyle. So, what's really going on here? In this video, we're going to dive deep into the myths surrounding real estate investing. You'll learn why it's often seen as a fast track to retirement, but in reality, it can be a long road filled with unexpected costs and challenges. We'll explore the truth about the hidden expenses that can eat into your profits, and why you might need more than just real estate to secure your financial future. By the end, you'll understand how to play the long game in real estate, turning it into a tool for building lasting wealth rather than just a quick escape from the 9-to-5 grind. Stay tuned, because what you learn might just change your entire approach to investing. Chapter 1. The Real Estate Mirage. Why everyone thinks it's a shortcut to early retirement. It's easy to see why people think real estate is a ticket to early retirement. Social media is full of flashy success stories, but what you don't hear about are the years of hard work behind those overnight successes. The truth is, real estate can build wealth, but it's not the get-rich-quick scheme many people expect. Consider this. The average home price in the US has increased by about 4.5% annually since 1991, according to the Federal Housing Finance Agency. While that sounds promising, it's hardly a fast track to millions. Sure, home prices do rise, but that appreciation doesn't happen overnight. In fact, if you look at the bigger picture, real estate wealth builds over decades, not years. The mirage comes from seeing properties as pure profit. But here's the catch: mortgage interest, property taxes, insurance, and upkeep costs eat into those profits fast. According to a study by Zillow, hidden expenses on a home can cost owners more than $9,000 annually. That's money coming out of your pocket before you even see a return. One famous quote from Robert Kiyosaki's Rich Dad Poor Dad states, "It's not how much money you make, it's how much money you keep." Real estate can help you keep wealth, but it's a slow and steady process. This is where expectations matter. If you want to retire early through real estate, prepare for a long road. Chapter 2. Slow and steady. Why real estate is a long game. The reality is, real estate investing is more like a marathon than a sprint. Many new investors jump in thinking they'll be financially free in a few years. But seasoned investors know real estate rewards patience, not speed. Data from the US Census Bureau shows that about 80% of real estate investors are in the game for over a decade. That's because the real payoff comes from long-term growth, not short-term flips. Properties need time to appreciate in value, and tenants need time to consistently pay rent before you can see significant returns. The compound growth of real estate takes time to show its true potential. For example, a study by Harvard's Joint Center for Housing Studies found that homeowners who hold their properties for at least 10 years see the most stable gains. Over that time, rent prices often increase while mortgage costs stay fixed, which boosts cash flow. Here's another insight: the more time you stay invested in real estate, the less risky it becomes. According to a study by the National Association of Realtors, holding onto a property for 10 years reduces the likelihood of market downturns impacting your return. Over the long run, real estate beats inflation and offers consistent cash flow, but only if you're willing to wait. If you want to win in real estate, the strategy is simple: think long-term. Expect to hold onto properties for at least a decade to see meaningful results. Real estate isn't about quick profits, it's about building wealth that lasts. Chapter 3. The hidden costs that eat your early retirement dreams. One of the biggest mistakes real estate investors make is underestimating the true cost of owning property. Sure, rental income can sound like easy money, but there are a lot of hidden costs that can chew through your profits. Let's break it down. First, you have to factor in the cost of maintaining the property. According to a report by HomeAdvisor, the average homeowner spends between 1% and 4% of a property's value on repairs each year. That means if you own a $300,000 house, you could be looking at up to $12,000 in maintenance costs annually. Then there are property taxes. In some states, property taxes can be a huge burden. For example, New Jersey homeowners pay an average of 2.13% of their home's value in property taxes each year. The highest in the U.S. Add to that homeowner's insurance, which typically runs between $1,200 and $1,500 per year. Vacancy is another hidden cost. Even with a good tenant, you may experience a few months of vacancy between renters. During that time, you're still responsible for paying the mortgage, insurance, and utilities. According to the U.S. Census Bureau, the national rental vacancy rate averages around 6.8%. That's over a month of lost income per year. You also can't forget about property management fees if you're not handling the day-to-day yourself. The average cost for property management ranges from 8% to 12% of monthly rental income. So, if you're collecting $2,000 a month in rent, you could be paying $240 to $360 to someone else just to manage the property. These costs add up quickly, and before you know it, your profits shrink. This is why it's important to calculate your expenses before buying a property. When you run the numbers realistically, you'll often see that real estate isn't the golden ticket to early retirement many think it is. Real estate can still be a great investment, but you have to know the true costs involved. Understanding these hidden expenses is key to building a solid, long-term strategy. Chapter 4. Alternatives to fast money. Real estate as a wealth preservation tool. Real estate is often marketed as a shortcut to quick cash, but the truth is, its real value lies in preserving wealth over time. Think of it like a safe, not a lottery ticket. Unlike stocks or cryptocurrencies, which can be extremely volatile, real estate tends to appreciate steadily, helping you protect your hard-earned money from inflation. According to data from the National Association of Realtors, the median home price in the U.S. has increased by 49% over the last 10 years. While that's not the explosive growth you might see in other investments, it's stable. And in times of economic downturn, real estate often holds its value better than other assets. What makes real estate particularly strong for wealth preservation is its tangible nature. Unlike paper investments, properties are real, physical assets that tend to retain value even when markets crash. This is why many wealthy individuals park their money in real estate to hedge against economic uncertainty. In The Millionaire Real Estate Investor, Gary Keller writes, "Real estate is a financial vehicle that helps you not only accumulate wealth but hold onto it. That's the mindset you should adopt. The focus shouldn't be on becoming a millionaire overnight but on preserving and growing your wealth consistently." Cash flow is another element of wealth preservation. As long as you maintain positive cash flow, real estate keeps paying you even in rough economic times. With the right rental strategy, you can create a steady income stream that helps you stay afloat while other investments may tank. So, don't look at real estate as a fast money opportunity. Instead, view it as a tool that helps you safeguard and steadily grow your financial future. Chapter 5. Diversification is king. Why real estate alone won't secure your future. Relying solely on real estate for financial freedom can be a risky move. Diversifying your investments is key to building long-term wealth. While real estate is a solid part of any portfolio, putting all your eggs in one basket can lead to trouble. According to a report from the Global Wealth Management Review, diversified portfolios that include a mix of stocks, bonds, and real estate tend to outperform those that rely on just one asset class. The reason is simple: when one part of your portfolio struggles, another part can pick up the slack. For example, in 2008, real estate took a massive hit during the housing crisis. However, investors with diversified portfolios that included safer assets like bonds or certain stocks were able to weather the storm better. If your entire portfolio is tied to real estate, you're vulnerable to market crashes, tenant issues, or local economic downturns. Diversifying doesn't just protect you from risk, it also opens up more growth opportunities. While real estate can offer steady returns, other assets, like equities, can offer faster growth in certain market conditions. According to historical data from J.P. Morgan Asset Management, the stock market has delivered an average annual return of about 10% over the past 90 years, which is higher than real estate's typical return. The key is balance. Allocate a portion of your investments to real estate, but don't neglect stocks, bonds, or even alternative assets like REITs, real estate investment trusts. which give you exposure to real estate without the hands-on responsibilities of managing properties. In his book The Intelligent Investor, Benjamin Graham stresses the importance of diversification, saying, "The essence of investment management is the management of risks, not the management of returns." By diversifying, you reduce the chances of any one market downturn wiping out your financial future. If you enjoyed this video, don't forget to like and subscribe for more insights on smart investing and building wealth. Your financial future is too important to leave to chance. Stay informed and stay ahead.